The concept of banking, in its most rudimentary form, can be traced back to ancient civilizations. In Mesopotamia, temples and palaces served as safe repositories for valuables, providing a rudimentary form of deposit banking. These institutions also extended loans, primarily for agricultural purposes, marking an early form of credit. Traders in ancient Egypt developed sophisticated systems of grain banking, using granaries as collateral for loans. As trade flourished across the Mediterranean, so too did the need for more sophisticated financial instruments. Ancient Greek temples not only safeguarded deposits, but also facilitated payments and money changing, acting as intermediaries in commercial transactions. These temples, with their vast resources and reputation for security, played a crucial role in financing trade and public works. The Roman Empire witnessed the emergence of professional bankers known as argentarii. These skilled financiers engaged in a wide range of activities, including deposit-taking, lending, money changing, and credit transfers. Roman law recognized contracts and debt, providing a legal framework for banking operations. The growth of trade and commerce within the vast empire fueled the expansion of banking services. The collapse of the Roman Empire in the West led to a decline in banking activity in Europe. However, banking practices continued to thrive in the East, particularly in the Byzantine Empire and the Islamic world. These regions preserved and built upon the financial innovations of earlier civilizations, laying the groundwork for the revival of banking in medieval Europe. To dive deeper into the evolution of finance and understand how stock prices increase and decrease, visit the link in the description. The revival of trade in medieval Europe brought about a resurgence of banking activities. Italian merchants, particularly those from Florence, Genoa, and Venice, played a pivotal role in this financial renaissance. These merchants, engaged in long-distance trade, required sophisticated financial instruments to manage their complex transactions. Merchant banking emerged as a response to the needs of these traders. Merchant bankers provided a range of services, including financing trade expeditions, exchanging currencies, and facilitating payments across long distances. They developed innovative financial instruments such as bills of exchange, which served as early forms of credit and reduced the need to transport large sums of money. The Knights Templar, a powerful religious order, also played a significant role in medieval banking. With their extensive network of preceptories across Europe and the Holy Land, they offered safe passage to pilgrims and merchants, as well as banking services. Their ability to transfer funds across long distances without the need for physical transportation was a testament to the growing sophistication of financial networks. The medieval period witnessed the development of double-entry bookkeeping, a revolutionary accounting method that provided a more accurate and transparent system for recording financial transactions. This innovation, originating in Italy, spread rapidly throughout Europe, revolutionizing accounting practices and laying the foundation for modern accounting standards. The transition from medieval to modern banking was marked by the emergence of new institutions and practices. Goldsmiths, originally craftsmen who worked with precious metals, played a pivotal role in this transformation. As custodians of valuable metals, they gradually expanded their services to include deposit-taking and lending. Goldsmiths realized that not all depositors would demand their gold simultaneously. This realization led them to lend out a portion of their deposits, creating new money in the process. This practice, known as fractional reserve banking, became a cornerstone of modern banking systems. It allowed banks to create credit, stimulating economic activity by providing funds for investment and consumption. The establishment of the Bank of England in 1694 marked a turning point in the evolution of banking. Created to finance the English government's war efforts, the Bank of England introduced the concept of a central bank. Central banks, with their unique ability to issue currency and regulate the money supply, became essential institutions in modern economies. The 18th and 19th centuries witnessed the proliferation of commercial banks, modelled after the Bank of England. These banks facilitated trade, financed industrial growth, and played a crucial role in the expansion of capitalism. Section 4. Banking and the Industrial Revolution, Fueling Economic Expansion. The Industrial Revolution, a period of unprecedented technological innovation and economic growth, was inextricably linked to the evolution of banking. Banks played a crucial role in financing the construction of factories, canals and railroads, providing the capital necessary for large-scale industrialization. The rise of industrial capitalism created a surge in demand for financial services. Entrepreneurs required capital to invest in new technologies and expand their operations. Banks, with their ability to pool savings and channel them into productive investments, became essential intermediaries in this process. The development of new financial instruments, such as corporate bonds and equity markets, provided additional avenues for raising capital. Banks played a key role in underwriting these securities, facilitating the flow of funds from savers to businesses. The expansion of credit fueled economic growth, leading to higher levels of production, consumption and employment. However, the rapid expansion of banking during this period was not without its challenges. Financial crises, often triggered by excessive speculation and risky lending practices, became a recurring feature of the industrial era. These crises highlighted the need for greater regulation and oversight of the banking system. Section 5. The evolution of banking regulations, from the Great Depression to the 21st century. The Great Depression of the 1930s, a global economic crisis of unprecedented scale, exposed the vulnerabilities of the unregulated banking system. The stock market crash of 1929 was a catalyst, but the underlying issues were far more complex and deep-rooted. The collapse of thousands of banks, triggered by a combination of factors including excessive speculation, risky lending practices, and a lack of deposit insurance, led to a sharp contraction in credit and a deepening of the economic downturn. People lost their life savings overnight, and the ripple effects were felt across all sectors of the economy. In response to the crisis, governments around the world implemented sweeping banking reforms. These reforms were aimed at stabilizing the financial system, restoring public confidence, and preventing future crises of similar magnitude. In the United States, the Glass-Steagall Act of 1933 separated commercial banking from investment banking, aiming to reduce risk-taking and protect depositors. This act was a cornerstone of the New Deal reforms and fundamentally reshaped the banking landscape. Deposit insurance schemes were introduced to restore confidence in the banking system, guaranteeing depositors' savings up to a certain limit. This measure was crucial in preventing bank runs and ensuring that people felt secure about their money. The post-World War II era witnessed a period of relative financial stability characterized by strong economic growth and limited financial crises. This stability was underpinned by robust regulatory frameworks and a cautious approach to financial innovation. However, the 1970s and 1980s saw a resurgence of financial deregulation as governments sought to promote competition and innovation in the financial sector. The belief was that a more competitive financial environment would lead to greater efficiency and economic growth. This deregulation, while fostering innovation, also contributed to increased risk-taking within the banking system. Financial institutions began to engage in more speculative activities, often with insufficient oversight. The global financial crisis of 2008, triggered by the collapse of the US subprime mortgage market, highlighted the interconnectedness of the global financial system and the need for stronger international regulatory cooperation. The crisis had far-reaching consequences, affecting economies worldwide and leading to severe recessions in many countries. The crisis led to the implementation of stricter capital requirements for banks, enhanced oversight of financial institutions, and the creation of new regulatory bodies, such as the Financial Stability Board, to monitor systemic risks. These measures aim to build a more resilient financial system capable of withstanding future shocks. As we moved into the 21st century, the evolution of banking regulations continued. Advances in technology brought new challenges and opportunities. necessitating ongoing adjustments to regulatory frameworks. Cybersecurity, digital currencies and fintech innovations are now at the forefront of regulatory discussions, ensuring that the banking system remains robust and secure in an ever-changing landscape. Today, global cooperation in banking regulations is more critical than ever. International bodies work together to harmonize standards and practices, recognizing that financial stability in one region can have profound implications for the entire world. The journey from the Great Depression to the 21st century has been marked by significant lessons and continuous evolution, shaping a more resilient and interconnected global financial system.